Hi everyone, this is Rob Roy of Elliott Wave Options. Each week I post a video on the S&P 500 with where we expect the market to go in the coming week, as well as a review of where the market's been over the previous week. Recently, however, I recorded a video with an outlook for the entire year of 2020. If you weren't able to attend that webinar live, no worries, we got you covered. Here's a condensed version with the highlights from that webinar. If you would, however, like to see the webinar in its entirety with a more in-depth review of where we expect the market to go for the coming year, just click on the link in the comments section below. And by the way, some of the things that we talked about in that outlook are already starting to happen. Enjoy this. Thanks for your time. Look forward to talking to you again soon. Take care, everybody. Hi, everyone, and welcome to our Elliott Wave Options Outlook for 2020. This is going to be an awful lot of fun. Before we begin, just a general comment on forecasting. When you're looking at Elliott Wave counts, it's important, in my opinion, not to get so obsessed. A lot of people get very obsessed with Elliott Wave counts and being so technical on getting the count right, etc. And it's okay to be an Elliott Wave technician or practitioner, but I trade based on Elliott Wave, and average trades last 2 to 3 days to 2 to 3 weeks kind of time frame. So with that in mind, what's going to happen, 9 months, 10 months, 11 months from now is kind of immaterial when you're focusing on a trader, unless you're Warren Buffett and you're just going to buy something now and hold it for the entire year. If you want to do that, great. But in the end, forecasting is a guideline. So here's a chart of the SPY. It's a monthly chart of the SPY. We use the SPY instead of the SPX because that's what we actually trade. You can trade the cash index, the SPX, which is the S&P 500 cash index, but that's very expensive. The SPY is 1/10. It's designed to follow or mirror what occurs with the SPX, but the SPY didn't start until January of 1993, but that's still a pretty good history, especially when you're going back and looking at Elliott Wave counts. Now, when you look at this, you can see that we're in a very large wave 3. That wave 1 is a mono wave. In other words, it was a pretty straight up move from when they started the SPY in 93 until it peaked around 2000. And then down in 2002, we came where we set the wave 2. But in between there, look within that wave 2, there's what's known as a flat. So we came down and hit the lows in 2002. Then we moved up in 2007 to the same highs that we were at 2000, and then came down and bottomed out in 2009 at roughly the same exact lows that we bottomed in 2002. So that's a 3-wave flat. So here's the wave 3. We're in the wave 3 moving into 2020 here. And you can see that with the fib extension at 261.8, that's roughly around 362. So here's what I was mentioning, where people say, well, it's too hard to figure out where the wave 3 is going to go. Well, here are the rules. If you go to looking at where the wave 1 is, the first extension target is 162. We're rounding up 161.8 is the first target. Well, we've already moved past that in the SPY, and you can see that we broke above it there in 2018, came back down and tested it, and now we're moving up from here. So we've already broken above that. So then the next level is 261.8. So that comes up at roughly 362. If we were to break above that in the wave 3, then the next target would be roughly 425. But we're a long way from that, and this is a monthly chart, so that's well into the future, past what we're doing here in tonight's webinar, which is just talking about where we're going to be at the end of 2020. So we're very likely to complete the wave 3 up somewhere near that 261.8% level. Now, that doesn't mean we're going straight there, but we're likely to get there at some point in time in the not too distant future. So we're going to go ahead and label that 362. One of the great things about Elliott Wave is fractals. Fractals are patterns within a pattern, waves within a wave. In other words, we don't have to just sit back and wait until 2030 to put on a trade. We can break it down. And so we break the pattern down, and in this wave 3 on the monthly chart, there is a wave 5 pattern, which you can see labeled on your chart. So where's the likely target of that wave 5 high? Well, at 161.8%, which again is a large, strong primary Fibonacci ratio, that brings us roughly to 346. So now we're going to look at just the wave 5 using Elliott Wave. You don't have to just put on trades expecting a target to be hit months away. You don't have to do that. You can break it down smaller than that. So there's the wave 5 within that 5-wave pattern within the wave 3. And look at the top of that target. Right at the top of that is, guess what, 346. So that's where the wave 5 forecast, there's a range there, but the top of the range is exactly at 346, the same exact spot that we just had within the 5-wave pattern of the wave 3. Now we're talking about the 5-wave pattern within the wave 5 giving us the exact same target. Fascinating. Well, also within that wave 5, there's one of those corrective patterns known as a zigzag. Zigzags are labeled with A, B, and C. And then the C wave extension moving up goes to, guess where? Guess where that 100% extension is? Another reading of 346. So now we have 3 different patterns, 3 different scenarios coming up with a 346 target, all the exact same value on the SPY. So you think that maybe we've got a fairly good chance of the SPY hitting 346? I would think. As I mentioned, I've been doing this for over 20 years, and I still today, when I see this stuff, I'm amazed by it. All right, so then what happens? Once we hit the 346, where do we go from there? So when we take a look at that, and now we're going to isolate just the C wave of the zigzag pattern, and here we are with 117% extension with that 5-wave extension within the C wave. There's another zigzag. So just within the C wave of the previous zigzag, we have another one, an A, B, and C within that. So again, breaking it down further and further, that's how we get to trading Elliott Wave, where we can trade where we're only in a trade for a few weeks, not months or years. There's the targets there, the 346, the 322 is already hit. That's already hit. So that was forecasted over the weekend. We're already there. So are we going to come down to those next fib levels, the 100%, the 61.8% level? We'll have to wait and see. But at this point in time, we've already hit one fib level, and that could be enough. Or we could come all the way down to that 100% level, which would be a primary level if we continue lower from here. So we filled the gap, we've satisfied that, and now we wait. So those are the things that we knew were going to happen. We knew that we were going to get a correction because we'd hit such a primary Fibonacci extension. We got the correction. It was a gap. We know the gap's going to get filled. The gap got filled. So the things that we knew were going to happen have happened. Now we let the market tell us where we're going to go. Remember what we talked about in the beginning? A forecast is only as good as the data that's input. Well, we need a little bit more data to figure out where we're going to go on the next few days. But if we come down to that 100% level, that's very likely to hold because that's a huge strength level. And then the run back up to 346 is highly likely to occur. Once we hit that, perhaps we retrace back to the where that wave 5 high is now, because that's 161.8% fib extension. That would be the previous strong fib extension if we hit 346 and come back and hit that at 332. And then we make our run up towards that 362 level. That makes a lot of sense. And you have to trade according to what the charts tell you. We're going to talk more about that a little bit later on. But it also, when you're creating forecasts, you want them to have some sort of common sense as well. Other things to consider when we're going through this, and this is where that common sense part comes in, is the election cycle. Obviously, we're in an election year. Here's something that I think is really important. Spreads on debt products are improving. Prior to the market correcting from 2000 to 2002, debt spreads starting to widen. That was a warning signal. That was your yellow flag, caution, caution. Hey, this rally is probably coming to an end. But note where we are now with the rally that started in 2018. Debt spreads are collapsing. The S&P rate of growth is actually less than it was in 1999. But here's the SPY. This is a weekly chart of the SPY. Now, the gain currently is not as high, 68% on the S&P, because all the money was moving into the NASDAQ. So you can see this was more of a 45-degree angle. So even though it may not be as high of a percentage gain, it's enough there that we want to be cautious about a potential correction, which we know we've already had over the last couple of trading days. Thing out there, a black swan, if you will, something that was unexpected, is that coronavirus. I don't think anybody knows, well, I know nobody knows how widespread that could be. The market doesn't like uncertainty. So far, the market, I think, has used this as a bit of an excuse to take some profits. That's what the move was that we saw the previous 2 days before today. But, the hysteria that was created over SARS when that came out, are we going to go there with this coronavirus? We might. It's something that we have to keep an eye on. So these are just things to keep in the back of your mind.